Good morning. How's everybody doing this morning? I'm Connie Foote with Foote Title Group, where we protect your home ownership. I'm checking in with you today. This is Coffee with Connie, and I really appreciate you taking the time to tune in. I know how important your valuable time is in the morning, particularly on the weekdays when we're trying to get our kids off to school, trying to get ready for work, and trying to get to work and deal with all the things that we have to do in the morning. And I appreciate you taking the time to tune in to find out some of the information that we have that we try to help you with every week, so that you understand more about home ownership, real estate, purchasing real estate, selling real estate, mortgaging real estate. And so I try to come to you live a couple times during the week to give you some information about those topics. And so I really appreciate you taking the time. So if you're on live with us, tune in and check in with me and say, hey, let me know that you're on. I really appreciate you checking in. Hey there, Lisa, how are you? Hey, Pam, good morning. Good to see you. I haven't seen you on in a little while, so I appreciate your time, guys. So this morning I wanted to talk to you for a few minutes about property taxes and insurance and how they affect your real estate, how they're included in your mortgage, and how those things actually work. Because, you know, a lot of terms start running around when you're talking about buying real estate. And so for the past 2 months, what we've done is try to talk to you about some things that are that are included, some terms you may see when you're buying a piece of real estate or selling a piece of real estate that you might need to know. So, cool. I just like to look and make sure that we have good signal. I was having a little trouble finding some signal this morning, so I just wanted to make sure that we have a good signal for you guys. So, so this morning we're talking about property taxes and real estate and how those things affect your mortgage and your monthly payment and why they're included. So first let's talk about your property taxes. So your property taxes are the taxes that you have to pay to the state and county government that are based on the property that you purchase. They're based on that value of that property. And so they charge you property taxes to make sure that you can get the services in the community that you live, that they can afford to take care of those. So we understand a little bit about property taxes and what they're for, but what we don't understand always is that when you're buying a piece of property and you're taking out a mortgage on that piece of property, the mortgage company is going to require that they make sure those property taxes are paid. And the reason for that is those property taxes are a first lien on your property. So what that means is when you take out a mortgage, the mortgage company wants to be first because they're loaning you a heck of a lot of money and they want to make sure that that money gets repaid to them. Well, the tax collector says, no way, our property taxes are going to get paid first. So if someone is not making their mortgage payment, then the property tax collector can sell that property to get those property taxes paid before the mortgage company is even involved. So the reason that that matters is, of course, the mortgage company says, oh my gosh, we want to make sure that we don't lose our mortgage. If that homeowner is not paying their mortgage payment, we want to make sure that those property taxes are paid so that our mortgage is taken care of. We don't ever want that county government or that state government selling that property and our mortgage not getting paid for. So what happens is the mortgage company says, well, I can't do a whole lot about the fact that the property taxes have the first right on your property, but what I can do is make sure that they're paid. So what they do is collect the money every month in your mortgage payment to make sure that your property taxes are paid every year when they come due. So there's no question that those property taxes are paid. And that's why they use the term called escrow, that they collect money in your monthly payment to make sure that your property taxes are paid. And the lender holds what's called an escrow. And the escrow is a fancy word for a savings account. Now, the reason that they have the fancy word is legally an escrow account cannot be used for anything other than what it's designed for. So the lender collects the money and holds that in a savings account, and the only thing they can do with it is pay your property taxes. So when that is created, the only way that they can make any payment out of that is when they get the property tax bill to make sure those property taxes are paid. So that's where the word escrow comes in, and the reason the lender collects the property taxes in your monthly mortgage payment. So when you go and you're starting to talk to a mortgage professional about what your payment's going to be on a new house you want to buy, the conversation goes to it's not just what it costs to repay the loan, but it's also what goes into your escrow account. So the escrow account covers the property taxes. And then let's talk for a minute about the insurance. So your homeowner's insurance, although it is not a lien against the property and doesn't affect the lender's interest as far as a lien against the property, it is something they want to make sure is paid every month. And why? Well, for obvious reasons. One of the things that they want to make sure is they want to make sure that that insurance is paid for. Why? Because what happens if you don't make your payment to your property insurance and something happens to your home? Well, if your house burns down, then there is no house that secures the loan that the mortgage company is loaning you money against. Well, darn, they sure as heck don't want something to happen to your house, and then all of a sudden, what they have secured their loan against doesn't exist anymore. So that's a really big deal for them. So the two things that a lender collects in escrow, in that savings out of your monthly mortgage payment, is your property taxes and your homeowner's insurance. So what they do is determine what 1/12, because they're going to do it for a whole year, what is 1/12 of your property taxes and 1/12 of your homeowner's insurance. Once they figure out what those bills are, then they add that to the monthly principal and interest payment for your mortgage. So what you're actually paying in your mortgage payment is principal and interest plus 1/12 of your tax bill and 1/12 of your insurance bill, so that your mortgage company can make sure that those two bills are paid so they don't have a problem with their mortgage. Because as we've talked many times, the lender is loaning you a heck of a lot of money, and they want to make sure that no one else can ever come in and take that home away, and thereby making their mortgage not worth anything because they can't recuperate that loan. So those two things are the two things that immediately they could control to make sure that those bills are paid so they don't lose that mortgage. So when you're first talking to a mortgage professional and you're talking about what your mortgage payment is going to be, the mortgage payment is going to be principal and interest. So the mortgage amount divided over all of the time that it takes to repay it, but also the interest calculation based on the interest rate that you're borrowing the money against. But that's not your only payment. Your payment also includes 1/12 of your tax bill and 1/12 of your insurance for these reasons. Now, let me say this. Sometimes people will get a mortgage and they won't be required to have an escrow account for taxes and insurance. That's very rare, but typically it is in situations where the people aren't borrowing very much money based on the value of that property, and the lender feels that their risk is a whole lot less. So if someone's borrowing 30% of the full value of the property, or maybe even up to 50%. Different lenders have different rules about what that number looks like. Then they may not require you deposit money into an account for the taxes and insurance and then make sure that those bills are paid. But that does not happen that often. Most of us need to borrow a good percentage of what that sales price of that home is to make sure that we can afford those monthly payments. So the lender will make sure that those are paid, and in some jurisdictions the lender needs you to send the tax bill to them so they can make sure that the bill is paid. But more often than not, the lender actually has a company that manages those escrow accounts for them, because as you can imagine, it's a huge mortgage company with lots of people that are actually making those payments, borrowers making those payments, and lots of tax bills and insurance bills in lots of jurisdictions to lots of different places. So a lot of times they have professionals, companies that they pay that actually manage those bills to make sure that they're all paid for you in the right time, at the right place, to make sure there's no penalties and to make sure that they don't fall through the cracks. So, hey there, Alexis. Good morning. Thanks for tuning in. Hey there, Brenda. How are you today? Good to see you. So that is a little bit about how the whole tax and insurance thing work. We're not just talking about your income tax, which we're all thinking about right now, but your property taxes when you buy a piece of property are determined based on the value of that home, and whatever that amount is, the lender is going to be collecting money to make sure they're paid. Now, the other question is, sometimes when things with your escrow or that savings account change, let's say your insurance bill goes up or your tax bill goes up. So every year the mortgage company analyzes that account to make sure that they're collecting enough to pay that bill. Now, sometimes it can get a little confusing because in areas where property taxes are paid in advance, then the tax bill comes in and they see the tax bill and they say, when property taxes are paid after the tax comes due, then the lender then realizes, oh my gosh, I haven't been collecting enough, so they may increase your monthly mortgage payment to cover the tax bill for the following year. And it also may cause a shortage in your account, so they may need to collect a little bit, not only to increase to make sure they have enough to pay the bill for next year, but also to catch up a little bit for this year because they didn't collect enough. So sometimes that can be a little bit confusing, and I recommend that you contact your mortgage professional if you have a question about that. Or, as always, you know, we don't do mortgages, and I am not a real estate agent, but we've been in the business for a long time. We understand a lot of these terms, and so we try to bring you information to prompt questions. So if something doesn't make sense or you have a question, you know where to go to hopefully get some of this information that you need. Well, thank you. I appreciate that. Gracie is there learning information too. That's wonderful. Hey, Gracie, how are you, girlie? So if you have those kind of questions, if you run into a situation where you don't understand, maybe you got a escrow statement that is going to change your mortgage payment and you don't understand what that is, call your mortgage professional and double check with them and get someone to walk you through that. And as always, if we can help you in the direction or maybe help answer some questions, we're certainly happy to do that. So we are able to help you in with closings in Maryland and Virginia, but we also have a lot of experience, basic real estate comments, information, questions that we want to direct you to that we can help you throughout. So hopefully that gave you a little information. Hey there, Roy. How are you today? Hope you're having an awesome day. Thank you guys so much for tuning in and checking in. It means the world to me. And the other thing is if you guys run through situations or maybe something comes up that you have a question that you don't understand, please feel free to reach out to me. I love answering questions that you have. I have a lot of content about things that we've had questions on in the past that I like to talk about. But if I have questions that may be things that I can help you with directly today, I'd like to be able to do that as well. So please reach out and let me know if you guys have those kind of questions that I can help with. And always, as always, I love talking to you. I love it when you check in and let me know. And hopefully I was able to help you with something that maybe you didn't understand today. Also, please do me a favor and share this information. Maybe you don't need it today, but maybe somebody you know does. So if you would share this video, I would really appreciate that. You also are welcome to go back to our website. There's lots of videos there that link back to our YouTube page. So maybe there's a question about something else pertaining to real estate that I've talked about that you didn't get a chance to check in on. You would be able to find that there, www.foottetitlegroup.com, on our blog, media and events page. There's a vlog there, the vlog for videos. I had just had to learn that recently too, so hopefully that helps you out a little bit. Maybe you can find something that you'd like to view there or share from there. So I'm Connie Foote with Foote Title Group, and hopefully I helped you with something that you didn't know today. Please share. I really appreciate you doing that and hope you guys have an awesome day. I'm Connie Foote with Foote Title Group, where we protect your home ownership. And this is Coffee with Connie, and I'll talk to you again soon. Have a great day, everybody.